My mission is simple, to help you protect your family and keep more of your money. I'm here to help level the playing field for families and those who seek the truth. There's always a new way to make money, but at the end of the day, it's your family's security and your legacy that matter. And I promise to help you protect what's really important to you. Legacy Money starts now. Hello, welcome to Legacy Money. I'm your host, Barry Page, the show that helps you live more, give more, and leave more. I'm excited today. We've got a great show for you. I'm going to be talking with author and fellow colleague of mine, Bryan Bloom, CPA. And really the goals of the show today are just to inform and educate and share the truth about money with you. So Bryan's been with us before, but welcome back to the show, Bryan. How are you today?
I'm doing great, Barry. I hope you're doing well today yourself.
Awesome. Really excited to be talking to you again. And I just want to get started with you, maybe telling us a little background. Tell us a little bit about yourself, your journey, your family, and how you became a CPA.
Well, I became a CPA by education at the University of Illinois in Urbana-Champaign, and came here as a student. Worked my way through the accountancy program, sat for the CPA exam, and passed it on the second time. Very few people get through it on the first time, but I made it through on the second time. And then I launched my career. And my first stop was at a retirement system, the State University's retirement system of Illinois. And it's a miraculous story in regards to how I got the position. That's for a whole nother conversation. But I got there as a staff accountant, and I worked my way up to the chief financial officer and the deputy director of the system before I left there to move to the private sector, where I began a career as a CPA doing private pension and 401k plan administration and design. And throughout that process between the retirement system and the third-party administrator, I started to realize that some of the traditional principles that were taught, and I was actually helping people implement, really weren't working. And so I made a huge switch. I switched from advocating for defined benefit, defined contribution retirement plans, where you defer the income to sometime in the future, to changing that all around and thinking, hey, you know what? Taxes have nowhere to go but up, and why on earth would I want to pay more taxes in the future than what I could be paying today? And then I switched into just a one-on-one practice where I met with individuals, helping them map out their retirement goals.
That's awesome. So you've worked on both sides of the fence, then the public, the private. And, I know when I first met you, probably about 5 or 6 years ago now, we were in a group together, the Breakaway League. And, I actually still have some notes. I got my notes out here from when I first heard you talk. And it was relieving. It was interesting. It was inspiring to hear an accountant and a CPA speak a little differently than what I was accustomed to, being a business owner and having met with many accountants over the years. But tell me, a little bit though about you personally. I know your faith and your family are real important to you. So tell me a little bit about, how that's played a part.
Sure. So, truth is a big deal. And so, I want to make sure that I am always advocating for the truth. That's just biblical in and of itself. And so that's kind of what drives me. And so I have my wife and I are now well-seasoned empty nesters. so much so that there's 4 almost soon to be 5 little grandchildren running around that came from our 2 daughters, who are have their own adult careers now and lifestyles. And so we've been blessed a lot with the family that we have, and we're thrilled by it. And I'm also thrilled by the fact that I love what I do. Sometimes we joke around, well, Bryan, when are you going to retire? And I just can't imagine not advocating for financial truth for the rest of my life.
That's awesome. That's great. That's great to hear that. And then, you journeyed out into business. You talked a little bit just earlier about going from the public to the private sector, but how about business? Tell us a little bit, maybe about some of your struggles along the way, shifting into your own private practice, and tell us a little bit about that.
Yeah, well, being a CPA, and I think we're all kind of like this, we're slow to move. And we really got to get kicked in the behind to actually move us. And God was very faithful to give me some really good pushes that I would not have done had I not had difficult circumstances that led up to the move. And so the state of Illinois is notoriously poor in regards to the funding of their public pensions. And we as a executive team and management staff began to push really hard against the state legislature to pony up what their financial obligations were to the potential retirees of the state universities and community colleges in Illinois. And during that process, as you can imagine, that got political. And the political became very difficult. I won't go into all the difficulties there, but it became apparent that through the changes that the state legislature was making in regards to the governance of the system, that things were going to change. We were allowed to be very entrepreneurial. We were state of the art. We had the first imaging system for paper records. And I'll still never forget the robotic movements of this huge computer system that would actually take magnetic tapes and grab them out of a library and move them over here and put them into a reader, and that would end up on my desk so I could see a part of the book. So we were the first to do that. That was unheard of. And so the entrepreneurial spirit was going to be eliminated just through the changes. And my last role at the retirement system was to conduct the executive search for the new executive director. And I knew what was coming, so I left.
Approximately when was that? How many years ago?
That would have been 1995.
Wow.
When I did that.
Wow. So, and now after many years, 30 plus years, I guess, as a CPA, you decided to write a series of books, and you've got the title right there behind you there, Confessions of a CPA, but you're now on your fourth book. That's right?
Yeah. In fact, so the first three, they're a series of nonfiction books, but the fourth one I'm working on right now is a fiction book. I've always wanted to write fiction. And what this book is going to be is it's a fictional account of a murder that happens on campus, and the most unlikely trio of people on both sides of the fence financially have to come together to solve the murder, and so that's kind of exciting. But the first three books are nonfiction, and they just expose what I've learned in a career. What works, what doesn't work, and it all came through trial and error on my own behalf, because I couldn't rely on what I was taught, because what I was taught was traditional, mainstream, not to the fault of the people who taught me, but they didn't necessarily have a lot of practical experience. They were all book knowledge, but they didn't realize how it worked in the real world. I started figuring out how it works in the real world with my own personal finances and some of the folks that I've been helping, and I go, what is going on? And so consequently, the books.
Sure. And I call it, when I refer many times to, accountants and CPAs that aren't very open-minded to change, they have blinders on. And, not again to say that any of these people are good or bad people, but why do you think the hesitancy, for accountants maybe to get away from, I guess, that standard, or not open up to really what's going on, like you did, to seek the truth, as we're discussing?
Well, it boils down to two things. Number one, we're an arrogant group of people, and number two, we're cheap.
Mm,
Okay. So
okay.
the arrogance piece of this is, you know, I know what I know. I've been trained. And we're regimented, and
Sure.
I'm sticking with what I was taught. And
Right.
like you said, with the blinders on,
Right.
and that's just pure arrogance.
Sure.
And then from the cheap standpoint is good grief. I spent a lot of money getting all this education. Don't tell me I'm wrong now. That
Right.
cost me a fortune. So
Right.
I've got to justify the money I spent.
Right. So, you're entering retirement. You just mentioned that you don't know when that'll be, but you're at that age, let's just say,
Mhm.
right?
But
So,
fair.
but you probably what I'm getting at is you probably have a little, I guess, less fear now. But in your working years, would you ever have thought that people would be silenced for trying to share the truth? There's a lot out there, and I'll just bring up someone that, obviously your books are about how to um, avoid legally paying income taxes.
Hmm.
But I'm not sure. Are you familiar with Irwin Schiff and his books?
No, I'm not.
Oh, wow.
Sorry.
Okay. How about Peter Schiff? You know who Peter Schiff is?
Yeah, I recognize that name.
Okay. So Peter Schiff is an Austrian economist. Great. He talks a lot about gold, but
Oh,
he's on
yeah,
the
right.
on
Okay,
the
got it.
okay. So his father was Irwin Schiff,
Hmm.
and he wrote a book, The Great Income Tax Hoax: Why You Can Immediately Stop Paying Illegally Enforced Taxes. And he was, in turn, arrested, and he actually died in a hospital bed, chained to a bed, for literally just writing a couple books similar to yours. So,
Oh my goodness.
my question, I guess, do you have fear of any of this retaliation, or do you fear the IRS in any way?
Not until now.
Well, I hate to bring that up, but often, and we've had discussions. Some people obviously don't like what we have to say, and it's mainly the financial institutions, and some people maybe in the government. But I was just curious as to that. We talked a little bit about your books and things disappearing online and
It's a,
whatnot.
yeah, I wouldn't call it fear, but it's a creeping feeling.
Yeah.
You wonder when or if something bad's going to come quote unquote at random because of something, a position you've taken. I think that permeates our society today.
Yeah.
It works a lot with this whole cancel culture.
Mhm.
Those are bad things that happen to good people because they took a stand for one thing or another.
Yeah.
I'm in the midst right now of an experience I didn't think I'd ever be in. This book right here, it's an update of it's an update of a book I wrote 10 years ago, and I just refreshed it for the 10th anniversary and got it uploaded to Amazon, and it was there for about 2 hours online. You could search for it, Confessions of a CPA. This book would show up, and about 2 hours after the listing, it disappeared.
Wow.
It's gone. Now, I don't know if I'm being censored or not, but I think because the word true is in the title, it's been taken down for a period of time. Now, this is what I've been told. So I contacted Amazon. I was on a phone call with them for an hour, and they finally concluded it needed to be escalated to the technology department. They'd be giving me a call. Well, that was 2 weeks ago. There's been no call. Then I started working with Amazon Direct Publishing, and they said, we have to talk to your publisher. I talked to my publisher. They said, we're not allowed to contact Amazon after an upload for 30 days to find out why the book's not been listed. And so here I am. I'm sitting here. But I do have a link to the initial listing. It's live, it's active. I had someone take that link and actually post a review, and they got an answer back from Amazon saying, thank you.
Hmm.
So Amazon has it. They're just not making it searchable. Now, Barnes and Noble has it as well. You can search it, pops right up. So I don't know if that's what's going on, but it sure sounds like it.
Sure. Well, I've read your other book, so I'm excited to get the new one. It's on order, so I can't wait for that. But just kind of shifting gears here a little bit to let's talk about the average family out there. Um, what what do you feel like the average family is missing, or what they should know about income taxes?
They're very well, they know this. They're very complicated, but
Mm,
they don't have to be.
mm,
Um, anything that comes as a benefit to them that contains numbers and letters is
mhm.
probably not in their best interest. Because,
Acronyms,
yeah, they're
parts of the code.
yeah, they're government provisions that allow you to do this, that, or the other thing. I mean, the obvious one is a 401k or a 403b plan where you don't have to pay your taxes on the money you earned this year. If you set that money aside for retirement, you don't have to pay taxes on it. And in fact, there's some financial entertainers that are on radio and have their own books, and they often refer to 401k plans as tax-free.
Yeah. I've even had accountants tell me that, Brian, that they're,
Yeah,
you
there's nothing
don't pay tax,
tax-free about
you
it.
save on taxes.
Yeah, and there's nothing free about it. You just don't. Well, you boil it down. Anything you owe today that you choose not to pay today
Mhm.
is called debt.
Right. Mm.
Debt is due sometime in the future. Usually we know when that is. You go to the bank and you get a loan and they tell you when you got to pay it back.
Yeah.
Well, the debt that you incur with the IRS for not paying your taxes today because you put the money in the 401k plan, when is that debt due? They don't tell you. What's the interest rate they're going to charge? They don't tell you, because the interest rate they're going to charge you on the taxes you don't pay today is tomorrow's tax rate. That's the interest rate.
How ironic is it that most people that literally hate debt, right?
Oh, yeah.
They have these types of plans, and it just baffles the mind sometimes. What about business owners? This whole pandemic has really, I guess, ushered in
Yeah.
many entrepreneurs work from home.
Yeah.
And so what advice do you have maybe for a business owner just getting
Sure.
started? In
Remember
general,
that.
I know it, like you said, it can get very
Yeah.
complicated, but just in general, what would you suggest for somebody just getting started, maybe with an online business or
Sure.
working
Bring
from
me
home?
back to that in just a minute, because I want to tell
Okay.
you a story. So
Okay.
I've had, on more than one occasion, I've had a couple sitting across the table from me, and I don't know if you'll be able to see this on the video, but I see one of these, and it's usually one spouse or the other. I'm not going to implicate which one, but we'll go through all this, and they will be telling me how they're debt free, how they paid off their house. They have no credit card debt. They finally got to hear the roar of the train whistle, that they're
Mhm.
now debt free. And we talked then about 401k plans and how they're nothing but a debt in the future, and at unknown interest rates due at an unknown time. And often I'll see that to the spouse and say, "Did you know that?" And they're mad. And they're mad. And that's Americans today. They don't know what they're really in for, and they don't know what they're in for because no one's told them. No one's defined what they're in for. So
Right.
anyway, so getting back to the business owner. Okay, so we've had this lesson at least twice during my career, and we just had the third occurrence of it. Okay,
Mhm.
the most dramatic issue or example of this was in 2008. So
Mhm.
I'm talking about market declines when liquidity becomes an issue. Okay, so
Okay.
a general market decline is going to, you got investable money and the market crashes 30, 40%, and now you have less money. Okay, well, in 2008, not only did you have less money, but the banks stopped lending money. Now, any
Mhm.
small business is dependent upon banks being their partner. They need a bank to help them make payroll. They need a bank to help them buy inventory in these ups and downs of cash flow. And so what happened in 2008, so many small businesses went out of business. They were thriving, except the cash flow went down. They couldn't pay their employees. They couldn't pay their vendors who provide their product, and they went out of business. Even though they had a very vibrant business plan, they went out of business. Now those folks learned that cash is king, and liquidity is something that you need to store up and shore up. You can't always rely on the banks. And so this most recent issue with COVID, when the markets crashed and everything closed down, those were the companies that survived. Those that had a storehouse of cash somewhere because they couldn't get money anywhere else. And so they became their own bank when the bank failed to be there for them. And that's the number one thing I would tell any small business. You can't just keep plowing money back into your business and relying on this third-party bank who's going to be your partner, because that partner is going to walk when it's in their best interest to walk.
Good stuff. So why do you think it is that so many people just continue to willingly invest and risk their hard-earned income in a government plan managed by those very same banks that we're talking about? Well, why do you think so many people are just, they're convinced that's the thing to do?
Right. Drip, 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 drip. They hear the same thing over and over again.
Right.
Defer your income. Pay off your house. You hear it from CPAs when you get your taxes done. You want to put $6,000 in your IRA. I can reduce your tax bill this year. See, you hire a CPA to do your taxes to reduce your taxes today.
Right.
So they're always going to advocate for you to put money into an IRA so that they can look good. Because
Sure.
if you owe too much more money than you think you should, you're not going to hire them next year. So they have a vested interest in this. And so they drip that on you every year, every April 15th. You want to put money in the 401k? You want to put money in the IRA, right? Right. Oh, it's in your best. Then you're driving down the road and you turn the radio on or Sirius, and you hear different radio financial entertainers. Defer your income. It's your 401k is tax free. Blah 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 blah. Then you go to the newsstand, or you go to some online service where you can download the current magazine that talks about money, and you work your way through that. And guess what they're saying? The exact same thing. And so it's people like you and I, we're swimming upstream trying to disclose financial truths, but we're really swimming upstream because everything else is pushing against us, and it's hard to get the word out.
That's good. It reminds me, I heard another colleague of ours, Todd Langford, who manufactures financial calculators, but he once said that we have to prove the truth, but yet lies get perpetuated without check.
Yep.
And I find that exactly what we're discussing here. That's
well, a good Todd Langford story is I trained with him in regards to his financial calculators, and I'll never forget the day. This was very early on in my career when he proved that a 0% car loan is not 0%.
Right.
Gosh. And it's like, well, duh. All you got to do is look at and do the math a little bit, and you realize it. I mean, and how dumb are we to think that we got something for free? We don't get anything for free.
Especially
that's not 0%.
It's amazing. It's amazing. Well, you talked a little earlier about the IRS taxes just being complicated, right?
Oh yeah.
And I just read a news story where, and it's you'll probably see it yesterday and today. It's in the news about the IRS being overwhelmed. They're warning to file early, file electronically because of the mounds of paperwork. So why do they make filing taxes so complicated, do you think? I mean, why is the tax code thousands of pages Is it just to confuse us, or is it,
Yeah.
is there some rhyme or reason behind it?
Oh, it's to wear you out. It's to wear you out. And the longer they can put things, notice that you never get and they're not audit letters, they're matching letters where they try to match what you declared on your tax return with what your employer or your investment advisor reported. It's 3 years. They
Right.
take 3 years to tell you that there was a problem 3 years ago. Why 3 years? Because that's the statute of limitations when they can actually question you on it. Okay, so it's 3 years. Now you got to dig all this stuff up and prove. And now I'm going to get off on tangents. You got to keep me here. But one of the biggest ones that your listeners and your clients need to know about is this whole idea of investment sales. Okay, if you don't know what's called the cost basis of the sale of your mutual fund or your stock, the IRS assumes it's zero, which means the entire transaction is taxable. You used after-tax dollars to buy the stock or to buy the mutual fund, and if you can't prove or you don't know what you paid for it, then you get to pay taxes on that money again. Okay, so a lot of people get these things called 1099-Bs in the mail from their broker-dealer association, and it tells them what they're supposed to put on their. Well, they don't know what to do with it, so they don't. They don't do anything with it because they don't know what to do with it. So then 3 years later, the IRS says, "Oh, well, here's these 1099. You sold some stock. It's all taxable." When it's not, and people get scared by an IRS letter and they pay. Okay, so that's one of the reasons why it's complicated, because they can scare you into paying. Okay, the other thing, and I've got a client that he's been working on this for 10 years now. They keep delaying and delaying everything with his tax return. They screwed it up about 10 years ago. He's been trying to prove it, and everything gets crossed in the mail, and they have yet to figure it out. We figured it out, but the IRS has yet to figure it out. And of course, then another tax year comes in, and that just exasperates the whole thing. And they're never gonna. He's gonna end up just saying, "Okay, I give up."
Yeah.
And that's part of it. They want to wear you out and make you give up and scare you into paying, and it is scary. They
Yeah.
can do bad things.
Well, so kind of shifting gears to a solution, some things that people can do, and I know that's what your books do. So I highly encourage everybody to get Bryan's books, Confessions of a CPA. But why do you think that so many people are leery of a centuries-old proven financial tool that we recommend, dividend-paying whole life insurance? Why do you think that's hated by so many people?
Yeah, Drip.
When it didn't used to be 30, 40, 50 years ago, it wasn't, but now it is.
Drip, 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 drip.
Yeah.
Again, we're bombarded everywhere that I don't know how it happened, but for some reason, dividend-paying life insurance got a bad name. I'm not sure how that happened, other than you keep hearing, "Oh, it's a bad idea. Oh, it's a bad investment. Oh, it's this," and no one checks it out.
Right.
Okay. So what I've tried to do with these 3 books is this one that you're looking at in my background pretty much discloses what's wrong with traditional planning, including the strategy that's called buy term and invest the rest. That's a life insurance strategy that doesn't necessarily work, because term insurance is set to fail. Okay, it's set to run out before you run out. Okay, and so less than 2% of all term life insurance policies ever pay a death benefit. Now, if that statistic is so low, who benefits from the sale of term insurance? The insurance companies.
Yeah.
Okay, but if you can figure out a way to make your life insurance permanent, well, then you can. I mean, then it's a good investment, but only a good investment if you die. Okay,
Sure.
so that's where it gets another bad. Well, you got to die to get it, and then of course you don't get it. All right, but it's a fine investment for that. Now that ushers in book 2, which is called The Truth About Life Insurance, Confessions of a CPA, The Truth About Life Insurance. And it begins to introduce a number of principles on how life insurance works like salt and pepper on a nice steak. Okay, a nice steak is tasty in and of itself, but you add a little bit of salt and pepper to it, and ooh, it's really good. The same thing with investments. If you've got investments, they might be performing just fine, but if you add a little bit of salt and pepper in terms of life insurance to that, it's amazing. Because just think about it. If you add life insurance to an investment portfolio, then you can pay down your investment portfolio aggressively in retirement. You can live on probably twice what the safe withdrawal rate is if you don't have life insurance. Well, why does life insurance make that work? Because at the death of one of the two members of a marriage, the death benefit's going to pay, and the death benefit's going to pay and replace every investment dollar you ever spent, and you get to do it again, and so you get more money to live on. Now, then from that perspective comes the third book, which is called The Capital Equivalent Value of Life Insurance. And the capital equivalent value examines life insurance as an investment. And all it does is it equates what rate of return you'd have to get somewhere else in whatever investment you want to look like to equal what you'd get out of a life insurance contract.
Right.
And it's really good. Now, it's not calculating the rate of return of life insurance. It's calculating the rate of return in any other asset to become the equivalent of life insurance when you account for everything. You see, because the investment distributions are going to make your Social Security taxable. The 401k distributions are going to cause your Medicare to go up a bracket. You know, that's that free health insurance that I think this year costs everyone $150 unless you make too much money. And when you account for all that, then the fact that life insurance is tax exempt during your lifetime, by the way, you don't have to die to get it, but during your lifetime it's tax exempt. It does not cause your Social Security to become taxable. It does not increase your Medicare premiums. When you account for all that, now this looks like a pretty darn good investment. It's not an investment. Don't get me wrong. Life insurance is not an investment, but it sure acts like one.
And I like that explanation and tying it all, back to how each book breaks it down. And you ended it with, it's not an investment. And as a matter of fact, because it's not, it avoids the fees, the risk,
right,
the taxes that we're talking about here,
right,
and which are things that people generally hate. But again, for whatever reason, they get trapped into these plans. And of course, life insurance can just make those plans better. You can leverage them. You can use it together with the plan. But that's all laid out in the books. And
Barry, let me just say this too. You don't have to wait until you're 65, 66, or until you die to start getting money out of these things. These life insurance, I mean, I have financed my kids' college education through using my life insurance. I just bought a car 2 years ago, and I like to say my dead self bought it because I spent $50,000 of my death benefits to buy my car today, and Pam just won't get $50,000 of death benefit, right? Who cares? But we don't think outside of the box, and that's what you can do with life insurance. You can use it early on, in probably 5 years into a policy, to buy a piece of real estate. Mm-hmm. Wow. So you don't have to wait till you're 65 to access it. You don't have to wait until you're dead.
Yeah. Do you think that the average person maybe that has a pension, if they're fortunate, or maybe even has some other type of executive plan at work or whatnot, or an annuity, a payout, do you think the average person understands that those are life insurance products that fund these plans many times?
No, I really don't. But in all essence, that's what it is. It's funny working with people with their pensions, whether it's private or public. They usually have an option at retirement of whether to provide survivor benefits to their spouse. And so
Mhm.
the way the story goes is, if you'll just take a little bit less every month for the rest of your life, then we'll pay your spouse half of your retirement. Okay, and that sounds enticing, but you know what that is? The reduction in your pension represents a life insurance premium.
Mhm.
That's all it is. So
Right.
even with these pension plans, they're advocating life insurance in
Sure.
that option period.
Sure.
People just don't know it.
Right, right. And so, kind of back to the IRS and the news, and obviously it's tax filing time. We're getting closer to April, so people are starting to file their income taxes. And I find that people, even if they've just got a single job, their W-2 income, they still go out to H&R Block and these places to get their taxes filed. And I recommend many times that, hey, if you've never done it, you just need to do it so you can see where your money is going, what's really going on with your money. Do you think the average person should be able to file their income taxes, and why? If they could, should they?
Well, and I think they can. I think people are just intimidated. They're going to miss this deduction or that deduction. We have stripped out so many deductions, it's not even funny. So unless you got a special life circumstance, like you just retired, or your child just went to school and there may be a tuition tax credit, it, you know, if you don't have any of those special life circumstances, you ought to do your own income taxes just to understand what's going on. It saddens me when I talk to people and they say, "Well, I didn't, I didn't know, I didn't pay any income taxes this year," and all they mean is they got a refund. They didn't have to add anything to it. That doesn't mean they didn't pay taxes during the year. In fact, they did, and they don't even know it. See, and this all started, Barry, back when we decided to do income tax withholding from wages.
Mm-hmm.
That was the first divide of the American public from knowing what's going on. They did the tax withholding. You didn't know. I mean, yeah, you took a little bit less home, and it was on a monthly basis, not $2,000 at the end of the year, and it was is like a frog in a pot of water that's cold, and they slowly turn up the heat, and before you know it, you got frog legs. I
Mm-hmm.
mean, if you throw the frog into a boiling pot of water, they know it. But here we are, we're slowly boiling to death, and that was the first was income tax withholding to numb us to what's going on. The next phase of numbing us to what's going on is telling you need H&R Block to do your taxes. Don't try it; it's too complicated, and that just removes us one more step from actually knowing what's going on. So if you can, you should just try it. Hey, do it this way: do your own taxes, and then take it to H&R Block. See how you did. Take it to
Yeah.
the teacher to grade it.
Yeah, that's good. That's good. Good advice. So obviously it can get real complicated, but I know, and you're an accountant, and I know accountants, attorneys, everybody has their place. But just generally speaking, what are your thoughts on trust and estate planning? Just in a big picture, what, for the average family that maybe has not done any estate plan, they don't have a will. They're getting close to retirement, and they're really starting to think about this. But you've got attorneys telling them, hey, you need a living trust, you need this, you put your business in a trust and put your life insurance in a trust. What are your general thoughts on that?
Yeah, it's going to be individualistic and specific to each person, but few people need what you're just talking about, because you can set up your accounts to have beneficiaries. Now, a beneficiary is merely a person who inherits your money outside of a will. Okay, so you don't need a
Mm-hmm.
will. So if I have an IRA, I can name a person a beneficiary, and that money gets transferred to that beneficiary immediately. It does not go through my will, so I don't need a will for that. Okay, um, and then there's some accounts where you can't name a beneficiary, but you can do what's called a transfer on death (TOD) order. It works just like a beneficiary, and you can move that out. And so you can actually die with what's called a small estate. And in a small estate, your executor can settle all the accounts without having to go through the court system. and they just do it with a small estate affidavit. So it can all happen. Now, there are a few times when you want to talk to an attorney in regards to more sophisticated issues. Some of that is retaining assets in the case of long-term care. You get to a point in life and you've got a long-term care issue that might come up. You may want to put assets into a trust at that point in order to deflect that money from the nursing home, taking it away with the absorbent fees. All right, now you got to do that trust within 5 years of needing it for that purpose. If you do it shorter, it doesn't matter anymore. But then you also have to realize too that when your loved one can't make the nursing home payment, even though there's a boatload of money over here in the trust, well, then they may move up a couple floors in the nursing home where the care may not be as good as for someone who is paying the real bucks. So there's a lot of trade-offs, but Barry, I would say a grand majority of people don't need to go through all the sophisticated estate planning stuff. You must have a will if you're a parent. It has nothing to do with the money. It has everything to do with your children. And if you don't have a will designating who the guardians of your children will be, the state will choose. And most of the time, people don't do a will because they don't know who to name, and there's conflict. Well, I want Aunt Susie to do it. I want Mom to do it, and they don't get a will. But I guarantee you, your worst choice as the guardian of your kids will be better than the state's first choice of who they should be if you don't have a will. So you've got to do that.
That should be clearly evident in the world we're living in today, for sure. But just kind of tagging on to the end of that, you brought up long-term care, and I think that's a real important issue. Earlier, you talked about Medicare and just the cost and everything that's involved with that. How can life insurance maybe help with this final estate planning and with those long-term care issues?
Sure. So, it's the difference between paying for long-term care insurance under the old system of what's called use it or lose it. So you pay a premium for insurance, it just like you pay a premium for your home insurance. And if your house doesn't burn down, you never use the insurance, you lose the economic value, but you got the peace of mind that said if your house does burn down, we're going to replace it. Okay, same thing goes with good old-fashioned long-term care insurance. You pay a premium for something you hope you never have to use. And if you never use it, you lose it. Okay, that's an economic reality of lots of people's financial plans. However, when you have a life insurance contract, they're generally come without expense until you do use it, but oftentimes you can prematurely use your death benefits for a long-term care stay. Now, they don't call it long-term care insurance. It's an accelerated benefits rider, and all that means is they're accelerating your death benefits in the case of certain events happening, but they usually map the same triggers that long-term care insurance would trigger, and you can use your death benefits prior to your death in order to pay for some of those expenses. I personally own those policies. When they first came out, that was the first policies Pam and I bought. We bought enough to make sure that our long-term care expenses would be covered by an accelerated death benefit if that time came.
Fantastic.
And of course, Barry, if you don't use it, well, then your loved ones get the death benefit.
Exactly.
So it's a no-cost way of doing it.
Absolutely. So we'll just kind of close on this, and you've already talked a little bit about your books, but your newest book behind you is just being released. And without giving away the prize, I know it's kind of a recap of your first book, 10-year anniversary, and you've updated it. But what is one of the maybe key takeaways that others would gain by reading the book, or why do you recommend it?
Well, we talked about a number of the issues, and they're the same. They're the 401k plan or the IRA. Why that doesn't work. We talk about, is your home an asset, or is it a place to live? We talk about buy term and invest, the difference. We talk about how can you purchase your car for half price. We talk about, and here's the linchpin to it all, we talk about the miracle of compound interest. If you don't understand the miracle of compound interest, the bank does, and they'll use it against you. And so the eighth wonder of the world, Barry, the eighth wonder of the world is not the miracle of compound interest. It's the miracle of uninterrupted compound interest. You gotta let that mess with your head a little bit. And so you've got to live on that exponential curve of Einstein's eighth wonder of the world, but you can't interrupt it. So you got to find a different way to spend the money that's in the compounding interest curve so that it doesn't count against you. Now, in the updated book, for any of your listeners who read the first book, there's the effects of COVID. What did COVID do to all of our financial planning things? Now, fortunately, with COVID, we recovered financially from it. But what if we don't the next time? It talks about that. It also talks about a newfound tax nightmare, and it's called layering. And we talk about layering taxable income. You know, we have trigger points where you may fall below and not have to pay income taxes, or we may fall below and you may not have to pay taxes on your Social Security. But what are the pitfalls of stacking income that raises what otherwise would have been non-taxable income to taxable income? Real easy case in point is you sell a security, you have a $20,000 gain on that security. Well, that becomes the first layer of income. Then on top of that falls your W-2. Well, this $20,000 all of a sudden caused this piece of your income maybe to be in a higher tax bracket. And that's called layering or stacking. And we talk about that in the new book as well.
That's awesome. Awesome. Well, so I encourage everyone to go out and read Bryan's books, Confessions of a CPA. And Bryan, I just want to close with this. It's a long-winded question, but I know it's important to you. So I want to get your thoughts. You talk a little bit about your brother in your second book, and I don't want to bring up a somber story here, but I know it's important. And you told me, or you told it, you spoke in the book, but tell me why, the name of the show is Legacy Money. So tell us why your financial legacy is important to you and why.
Now, let me tell my brother's story. He was one of my first clients.
Okay.
In personal planning. He was my brother. He believed me in anything I said. He was going to do whatever he was the easiest client to work with. And we talked about his retirement. And we put in a life insurance plan where instead of putting his unmatched 401k money into the 401k plan money, he decided to put it into a life insurance contract because 25 years later, he was going to start to take money out of the life insurance contract and not have to pay income taxes on it. That was the plan. He never got to retirement. He died at 54. And instead of enjoying his retirement, he was able to make sure mom and dad had plenty of money to live on the rest of their lives because that death benefit paid what otherwise it would have been, what any other investment would have been worth at his age 100. It paid that at his age 54 to mom and dad. That wasn't what he intended. But despite their loss, they gained. Now they would have never traded him for the money. But they were set. They were set. And that's legacy.
Yes, yes.
I feel the same way. I think the generation below me, my kids, but now even more so my grandkids, I don't think they've got much of a chance without a hand up. Not a hand out. But with our money, can't we do something to give the next generations a hand up financially so that they're not trying to reinvent the wheel and in an economic environment that is so uncertain with a government that's got their hand? I mean, Barry, think about it. the last 2 years, just the last 2 years, do you think our government's going to need more money or less money in the future? And it doesn't matter what side of the aisle they're on, but yet that's what our kids and our grandkids are going to face.
It's
And
scary.
in our generation, we can't give them a hand up. That's called legacy, giving someone a hand up. It's not a hand out, it's a hand up to be successful. That's what I'm about.
Fantastic. Awesome, Bryan. Well, thank you so much for coming on our show today and for sharing the truth, your knowledge, and we appreciate it. And we look forward to seeing you. Be sure to get Bryan's books, Confessions of a CPA, and we'll see you in the next video. Have a great day.
Thanks, Barry.
Thank you, Bryan.